Hi there, welcome to Grain TV. I'm Kevin McNew. It is Tuesday, January 24th, and another mixed day in the markets. Let's take a look at GrainEdge's trading platform and see where we closed. In Chicago, corn and wheat giving up the last few days of gains, both losing around 6 cents a bushel. Old crop March beans managed to close only a penny higher, but had been down as much as 9 cents at one point on the day. Really today was sort of a mixed bag in terms of some of the news that was floating around. Let's start first of all with the good news, and that was some export sales deals. We haven't had many flash sales from USDA. We got some this morning to talk about. First of all, in soybeans, we had two different deals announced. One for 163,000 metric tons to unknown destinations, and another 112,000 metric tons to Mexico. Mexico usually not a buyer in big volumes of beans, but they were today. Also, Mexico buying 125,000 metric tons of corn. On the converse side of the Mexico situation, some of the news floating around today centered on the NAFTA deal, and Mexico saying they are not interested in renegotiating NAFTA and instead just take a break from it if that's indeed what happens and the renegotiations are not in their favor. So I think there is some ongoing concern. We had yesterday's TPP deal formally revoked in terms of U.S. participation by the Trump administration. Today there's focus on NAFTA, and so I think some of that had traders taking some profits from the run-up in corn up to 1070 today and backed us down to 1064. So maybe not a game changer, but certainly there's a lot of trade deals sort of being pulled around or at least potentially renegotiated, and there is some pause for concern there. In South America, the situation continues to be continued dryness in Argentina, where they had been wet, and early planted beans are now starting to get harvested in Mato Grosso. Numbers there suggest the Mato Grosso beans that are coming off are fairly good. The yields there are running around 54 to 55 bags to the acre versus 51 normally. These are early season, so it's still way too early to call that indicative of the rest of the region as well as the country, but early indications are the yields are good. They're still having some slowness there because of wet growing or the wet weather they've experienced here of late. In Argentina, it is getting hot and dry. The hot is needed at this time because they have been so wet. As they look ahead, it's pretty unclear what's going to happen, but some analysts down there suggest that the losses on the wet side may not be compensated from the increases on the dry that have had good growing conditions here. So, analysts there are still calling for 52 to 54 million metric ton crop versus USDA at 57. Also interesting to note that farmers in both Brazil and Argentina are likely going to be slow sellers off the combine, especially in Argentina, where they have a much bigger incentive to sell corn now that they face limited export restrictions in the world market. Before President Marco came on the board last November 2015. They had heavy export restrictions, export taxes on wheat, on corn. Those have been lifted. Last year, they spent most of their time exporting their corn to Brazil because of the shortfall there. So this year, I think, will be the full force we will feel from Argentina's corn crop in the world market, and that is likely going to hit at the end of February. Speaking of numbers, let's take a look at Informa's latest numbers. Informa came out with 2017 forecast for U.S. plantings, and in corn and beans, they were actually somewhat light compared to recent analysts. If we look at last week's Farm Futures survey, they pegged corn and bean plantings around 90.5 for both corn and beans. Beans, that's a 7 million acre increase over last year that Farm Futures was expecting. Informa last time had come in at 88.9. Many had thought that this latest Informa number which would ratchet up their soybean forecast. Instead, they actually backed it off to 88.6. Meanwhile, they ratcheted up the corn forecast to 90.5. Speaking of soybeans, yesterday on Grain TV, if you didn't have a chance to watch it, go back and watch it. We talked about the Chinese hog margin and how important that is for our export situation and their need for soybeans. We attributed much of that rally March to June of last year, driven by skyrocketing hog margins, hog profitability in China. This time now, we are seeing hog margins start to back off. They rallied from October to January, but we think January may have been a peak in that hog margin cycle, and we may be turning lower. The other thing to be watching out for is how much activity they're going to need to be buying between now and the end of the marketing year. Let's take a look at the next graphic on year by year over the last 8 years, what China has bought from the U.S. in the January to September, the later half of the marketing year's season. And what I want you to focus in on are these three areas outlined in red. 2008 and 9, 2011 and 12, 2015 and 16, last year, 2015 and 16. These 3 years are years when China was aggressive buyers of U.S. beans in the later half of the marketing season, January to September, buying in those years more than 5 million metric tons. Most of the other years, they bought limited amounts, sometimes less than 1 million metric tons, but usually something less than 2 million metric tons. But in these 3 years highlighted in red, what made those years what made China be big buyers in those years? The first two on this chart, 2008 and 9, 2011 and 12, those were years when South America had very, very big losses in their soybean crop. So obviously China sort of buys from both sides of the equator. They buy from South America, they buy from the U.S. When South America's growing season was particularly bad in those years we saw 12 to 18% crop losses from the January forecast by USDA. So we had big crop losses in South America. China ended up buying a lot more beans from the U.S. in that later half of our marketing year. But last year, 2015-16, that was not the case. They had a slightly less than expected crop in South America, but the big driver was they were undercommitted. Only 31% of their export commitments were booked as of January. Normally they're about 38%. So you add that they were undercommitted in January, and that they had this huge surge in the hog margin going from January to June, then that led to a big driver in Chinese imports from the U.S. or Chinese buying activity from the U.S. This year, where do we sit? January, mid-January, same comparisons that we're using in this table. China has booked 38% of what USDA says they're going to import. That's pretty much normal to where they usually are. Usually in these 8 years, on average, about 38%, 31% being the low, 50% being the high. So they are sitting somewhere around where they normally are. So my question is, how do we see China be a big-time buyer from the U.S. in the next 8 to 9 months of the marketing season? Two things have to happen, or one of them in significance. One, that hog margin has to turn substantially higher, or South America has to have a very steep loss in their production. Right now, the numbers we're hearing are not that steep. We're talking about 2 to 3 million metric tons, 4 to 5 million metric tons off of a total 157 million metric ton crop. So it's not a 10 to 15% loss that has generally triggered China being an aggressive buyer. With that said, we did see downward action today. Again, in March beans, we got down to 1050. If we look at the 10-minute chart from the Grain Hedge trading platform, it was starting to feel like a turnaround Tuesday. We were off yesterday 9 cents. In the overnight session, we were actually up as much as 7 cents, and you can see where the overnight session laid on this chart. And we had strength in the palm oil market, we had strength in Chinese bean futures. Everything was looking good for turnaround Tuesday, but when we hit the opening bell, you can see the big gap lower, and we traded 9 cents from 1060 down to 1051 pretty quickly over that 1 hour period. Now, interestingly enough, soybeans were able to reverse and actually recover some of those losses, closing 1 cent higher on the day, not quite getting up to 1060, but getting within striking distance of it on the close. Corn, on the other hand, stayed down and flat and closed near the lows all day. Wheat doing the same thing. It was a very sort of down day in the feed grains and wheat, and overall it just felt like that was a market that was really coming under pressure. Again, maybe attributed to some of the trade concerns we have going forward, maybe attributed to just the overall strength we've had. These are markets that are still continuing to struggle globally speaking, and you know, in a big picture sense, with very, very big supply. So it's not a market that is going to run away from us. So any sort of rallies, and especially as we get into the upside of the range where we're at now with corn at, you know, at one point at 1070, 6 months high, that is probably going to trigger some selling, and we saw that today. That's all we've got for Grain TV. As always, if you'd like to learn more about how we can help you in your own grain marketing situation, visit us online at grainhedge.com. Have a great day. We'll talk to you tomorrow about EIA ethanol data.